S-Corporation warnings that every business should be aware of. Before you elect S status, you need to be aware of the pitfalls that exist. Before the end of this video, I'm going to explain to you some of the pitfalls, but I'm going to give you the biggest, and it's the one that surprises everyone. And with that being said, let's talk about what an S-Corp is. First, an S-Corp is not an entity. It's not in and of itself an entity. It's a tax election. What does that mean? You form either an LLC and elect to be a corporation and elect S status, or you form a corporation and elect S status. It's an election that's made. So it's not a separate entity. It's a corporation or an LLC that has elected S status. That's the first thing. Let's start with how do S-Corp save money? What is it that saves money? Let's assume you're a Schedule C business. You've got $100,000 in profit. At the end of the year, you do your return. That goes on your return. You pay self-employment tax of 15.3%. You pay income tax of, let's just say, for argument's sake, it's 15%. That's 30%. 30 grand of that 100 grand goes to the IRS for federal income tax. But the part that gets saved with an S-Corp, let's use that same example. You're a sole proprietor. You have $100,000 in profit. You pay yourself a reasonable salary of $50,000. You take distributions of $50,000. So now your self-employment tax is only on that reasonable salary, $50,000. What has escaped is $50,000 of distributions. What's the savings? The savings of the distributions is you don't pay self-employment tax of 15.3% on that $50,000 in distributions. So you save $7,500 straight away on the surface. But what have you done? Did you start as a proprietorship and then form this organization and elect as status? If you did, you didn't save $7,500, assuming you don't prepare your own tax return. But what you've created now is the need for payroll tax filings. Generally, you've got to maintain a balance sheet. These other hoops you have to jump for, not to mention the fact that you now have an S corporation return to file. So what does that cost? $1,000, $1,500, $2,000. What is the accounting cost if you don't do the accounting to do professional or good accounting? So you maintain a balance sheet, you dot all the I's, cross all the T's. That's an additional cost. Did you have to incur additional costs now for payroll tax filings? What did it cost? Did it cost $1,000, $2,000, $3,000? So let's say it's $3,000. You saved not $7,500 now, you saved $4,500 because you've incurred these additional costs. So my point with all of that is, if you're a small business out there with making 20 grand, 25 grand, maybe it's a side hustle, maybe it's whatever, unless you need to form some entity for liability purposes, don't just jump into the boat of, hey, I'll form an S-Corp and I'm going to save all this money, because it may not be true. You've got to weigh the difference. That's why you'll see most people say, oh yeah, the S-Corp, when you get to about $50,000, $60,000 in profits, when it really pays off. My idea is a little higher than that. 100,000 is when it really starts to pay off, because then you start getting into some significant tax savings. So when you're, in our example, that $100,000 saves $7,500 right off the bat. And, it will cost additional to have additional returns and stuff filed, but that's still $4,000 or $5,000 a year. So you weigh the difference. You tell me if it's worth it or not. With that being said, let's say you decide to go jump into that S-Corp. Let's say you're making $100,000 net profit. Now the question arises as to what is a reasonable salary? No, it's not a percentage of your profits. I've had so many people tell me, I've had clients that have brought their business to me. I look at the return, I say, how did you arrive at that reasonable salary? Oh, well, my prior guy, my tax guy told me, or tax girl told me, as long as your distributions aren't more than your payroll, you're okay. That's not the truth. It's not fact. It's the way many people do it. And I've been guilty. I've done it a couple of times. But because generally the IRS, when they look at that, when your distributions are in excess of your salary, that I think, I don't know this, it's not fact. None of this is personal advice. Seek advice from your tax professional, period. This is my opinion, my experience. But reasonable salary needs to be documented. I now document all my clients' reasonable salary. And I do that a number of different ways, but it's documented, it's consistent, it's what we use year after year, regardless of what the profit is. You don't just adjust your salary based on how much money's in the bank. Can't do that. That's why I'll get to some other pitfalls, or I'll get to some businesses that this is better for and not so good for. But so that's reasonable salary. You need to make sure that stuff is documented, and you need to be prepared to defend it. So third-party documentation is what I say. We've taken care of the reasonable salary issue. You're still with me? You still think that's the way to go? Great. It probably is. You just have to remember the pitfalls, the additional cost, the reasonable salary issue, and the number one is coming later. Let's move on. It's Thanksgiving here, and I'm in the mountains, and I'm enjoying the outside, so excuse me if I get distracted. We've talked about the payroll cost. We need to talk about depreciation. When you're a Schedule C, you have something that's available to you called Section 179 depreciation. In layman's terms, is where you write how much asset purchase can I write off in 1 year? And it's a lot. And you may have used that as a tool in the past, because if you have other earned income, maybe it's a job, maybe the spouse is involved in the business with you and she has a job, but you have other earned income, you're able to create a bigger loss with that depreciation deduction when you are a sole proprietor. When you turn into an entity and you turn into an S corporation, you elect S status, that entity is then, those limitations are applied at the entity level and the individual level. So all that asset purchase that you thought you were going to get to write off may be limited by the income of the entity itself before it ever gets to you. People come to me with the S-Corp and like, hey, yeah, I bought a bunch of equipment. I'm like, it's useless. Does you no good. We can take bonus depreciation. We can take accelerated depreciation. We can do a lot of stuff, but it does you no good when you get to the individual level because it's stopped at the entity level. Remember, at S-Corp, all the income and expense flows right through to your tax return. It has a separate return to file, but there's no tax due on it, generally. Some rare instances, but generally. So you've created all that headache only to realize that, hey, I don't have this tool available to me anymore. This tool that I'm using to, when I reinvest in my business, I'm able to use all of these depreciation tools. They may not be available. There's another pitfall. I've seen people start these things and then when it's all said and done, realize they hadn't done a dang thing to save any real money. They've just limited themselves in certain ways. So that's another pitfall. Depreciation, don't forget about that. Who S corporations are really good for are, we talked about the income amount, generally higher income. You assign that level, you tell me. But, I say 100,000 and up, others say less. But consistent income, consistent year after year income. Realtors, financial advisors, consultants, tradespeople even. If you own your own HVAC company or plumbing company, consistently have income could be very good for you. If you're running an income consistently year after year after year, it's generally a good thing. Where it's not so good are startups, businesses that are inconsistent in revenue recognition, that may have high income one year, big loss the next, low margin operations, maybe people that expect several years of losses. Generally, and that's where the last pitfall comes in. Generally, not so hot, not so good. You've also got to remember that when you form this S corp, there's no more commingling of personal assets with business assets. The corporation's books need to be separately maintained and well maintained. You've got to maintain a balance sheet, meaning all your asset accounts, all your liability accounts need to reconcile with your profit and loss or your income statement. All that stuff people forget about. It's no more just like a Schedule C. Give me your income, give me your expenses, the net goes on the front of your tax return. Now you've got a balance sheet to report for, a separate return to file, payroll returns to file, because you've got to pay yourself a salary. And so you need to be aware about that. You need to also be aware of accountable reimbursement plans that need to go through the S corp, mileage reimbursements, personal expenses that are paid personally but for the business. Fringe benefits become different. All of these things, go together, and that's why I always say, and I know you get sick of it, but I always say, seek advice from your tax professional. There are all these variables that go in. There's no answer that I can give for is it good or is it not good. There's no right answer. So that brings me to the big pitfall. I'm going to try to explain this in layman's terms as easy as I can. You have something in an S corporation called basis. That's money you put in minus money you take out. That's also income the S corporation makes and you're taxed on. It's also losses the S corporation has and you get to deduct. So think of it like a bucket. Money you put in adds to your basis. Money you take out takes away from the basis. Income the S corporation earns adds to the basis. Losses that go out take away from the basis. So that bucket exists, and that's your basis, and you keep track of that from year to year. In other business entities, partnerships, sole proprietorships, Schedule C, you get basis in that entity based on any loans that entity takes that you're responsible for, that you sign. With an S corp, it does not work that way. So, in the example of an S corp that loses money, and this is the pitfall, you go out, you start an S corp, and you think, man, everything is great, but you borrow money. The S corp goes down to the bank, borrows $300,000 for operating expenses. In the first year, you expect to lose some money. In the second year, maybe. In the third year, maybe. So, you borrow the S corp borrows the money, and it does its operations. In year one, it loses 50 grand. You go down to your tax professional, your CPA, whatever, and you say, hey, look, I'm not going to have much tax this year. My S corp, we lost 50,000. There it is. And he says, yeah, that's great. You don't get any of it. Zero. And you think, what? He said, you have no basis. You may have put 10 grand in to start the bank account, went down and borrowed 100, lost 50 of it in the first year. But you anticipated all that. It's going to take you a couple of years to get up and running. You deduct none of that. You get no basis for that money that the bank put in your account. Even though the S corporation, even though you may have signed for it as a personal guarantor, you get no basis. The S corp pays the loan back, and you have a suspended loss. And guess what? Let's say in that example, you took out 10 grand as a distribution. That 10 grand is now called distributions in excess of basis. It's taxed as a 4797 gain. All this is jargon. What you need to know is, in that example, that 10 grand you pulled out and took as a distribution, it's taxable to you. Now, your salary, you know that. Let's say you paid yourself 10 grand, you took 10 grand in distributions. That salary is taxable. It's a W-2. You already get that. The S-Corp deducts it as a salary. That's no big deal. that 10 grand you took out was a distribution in excess of basis. You had nothing in your bucket. Or let's say you put 10 grand in. You can take that distribution then out. Okay. Let's say you didn't put anything in. Let's say you started the corporation with nothing. You went down and borrowed 100 grand. Put that in the business. It lost 50. Out comes the K1. 50 grand loss right there on the K1. You take it to your tax professional and you say, here it is, I lost 50 grand. They say, you deduct nothing. It carries forward. And that 10 grand distribution you took, that's taxable. Capital gain. Sale of business property, whatever you want to call it. So that's the biggest pitfall. I have had that happen more than once. Company comes in, a client comes in, we look at it, and I say, what's your basis? They say, what? I say, okay, bring me all the prior year tax returns, bring me the records. I calculate the basis. And they may have even been deducting that and not know it. I had one client actually deducting those losses year after year after year on their tax return and not knowing it. If they would have been audited, all those tax returns would have been recalculated, the penalties and interest would have mounted. So you think, oh, I can go down and do this myself, start the S-Corp. You don't know about the law. You don't know what questions to ask AI, right? You don't know to ask about distributions in excessive basis. You just rock along, do your return. AI helps you get the K1, put it in TurboTax. TurboTax will spit out a big refund. And you've done it all wrong because you've taken losses that you should not have taken. You had no basis in the stock. So that's the biggest pitfall. I want you to be aware of that. Those other things we've talked about, if you have any questions, just leave those in the comments. I'll answer those. I'm going to do more in-depth videos about S corporations. If you want to hear that kind of stuff, if you want to be part of this community, just join, just subscribe and comment, leave me a question. I want to answer and help as many people as I can, but my videos are not personal advice, purely my opinion and my experience. That's it. I hope you have a happy Thanksgiving. Thank you for watching.